Hey guys, welcome. Hey, this is Bob Maurer. I wanted to put together a video here to give you an idea of the strategy development process that I have prior to publishing the strategies in the My Futures Advisor portal. So what you guys are seeing is the end result of about a 12 or 13 step process, and I've been asked a number of times how I get to that end result. So I thought I'd throw this together for you. Now, this could be a rather lengthy video if I went into all the details. So I'm going to kind of hit some of these things with a little more detail, bring in a couple of outside sources, just so you can gain a feel for what I'm talking about here. And then with some, it'll just be more of a larger brush stroke. So essentially what we have here in the My Futures Advisor weekly strategy sheet is a strategy summary, and each one has a spread, and it has a approximate start date, approximate end date, and then it also has the actual levels to get into the trade, generally speaking, to get out of the trade with a profit, to get out of the trade with a loss, because you need to always have risk management in mind just in case. Okay, so I'll give you an idea of how I get to this, how I get to these different little data points that are on the strategy summary, from which we use as a basis to potentially go ahead and get into the marketplace. Now, first things first, I want to call this basically the anatomy of a seasonal futures spread strategy, and I want to go over the risk. The ones who survive in the futures markets are the ones who spend more time concerned with the risk than they are about the gains. Okay, they keep their eye on the prize. All right, there's always hope that the trade's going to come out, but hope doesn't make a good strategy in terms of risk management. So know these 5 points. These are the minimal 5 points you need to know when you get involved with either outright futures, options on futures, or spreads on futures. All these markets involve substantial risk. There's a huge amounts of leverage. There's a huge amounts of variables that are pumped into the price and can cause great volatility. So beware of that. The information here that you're about to see is what I think is generated from reliable sources, but it is what it is. If they're not reliable, then I can't be providing reliable information. I think it's reliable, so we'll just take it from there. This is just for educational purposes. Don't act on anything. You always got to take anything and put it through your own gray matter, period, end of story. Past performance is no guarantee of future results. That's absolutely true. And hypothetical results are not in any way founded in reality. There's way too many variables when you start actually trading with actual money in the actual marketplace that just cannot be accounted for through hypothetical results. So I am no different than others. If I start talking hypotheticals in this scenario, which I am basically, then you need to put your own little reality check on it and make sure it's something you can deal with. So in the strategy development process, there's a number of steps. Okay, the very first one is archive of recurring tendencies. So this basically starts with the foundation of looking for spread trades that have some kind of statistical background or statistical foundation in recurring in the calendar year. Okay, so we have an archive of recurring tendencies, and this archive comes from my own brain after doing this for as long as I have been. And then also there's plenty of other sources such as the clearing firm's research. I see some seasonal tendencies that are published through there, and there's also some outside third-party services that publish recurring tendencies. Okay, then from there we go into a deeper dive into those tendencies and start doing some statistical analysis, which includes correlations, kind of looking at this year and how they compare to previous years. We also then go into quantifying the risk and the reward, and we then compare the backdrop of the charts for some technical analysis to tweak the strategy, and then we actually do the strategy development. And that last stage there is one of the last steps where, before publishing it on the weekly strategy sheet. So we'll take these one by one here. Archive of recurring tendencies. So generally I'm looking for a risk to reward of about 2 to 1. There are some exceptions. All right, so if you got a really high probability trade with a low drawdown and it might only be a 1 to 1 type of scenario, might be one that we take. But generally speaking, I'm looking for a recurring tendency with a reward to risk of about 2 to 1. I want it to be a reasonable duration. Sometimes you see these seasonal tendency strategies published, and it might be on day 1 you get long a spread or you get long a futures contract, and on day 152 you sell it, and generally speaking you're going to make money over a large sample of years. Well, that's an insane trade. There's so much that can happen in the meantime with these highly geared products that it's just a ridiculous notion, in my humble opinion, to be in a trade that long. Even 90 days seems like an eternity. So I generally look for 30 days or less. Generally speaking, about 30 days or less. And that's calendar days. So when you actually subtract out weekend days and potential holidays in certain months, you're only talking roughly a 20-day trade. Adequate liquidity. Hard to get involved with trades where, if you get in, it's a big door, but you want to get out and it's a small door. All right, that's a problem. So you want to make sure you're in some kind of spread that offers adequate liquidity. There are some who get involved with such markets like dairy, etc., and lumber futures. Well, they'll give it a shot. I don't think that's for me, and I generally don't publish those trades within that particular market, even if the tendencies are high. Statistical analysis, win percentage, roughly about a 10 to 20 year look back. So basically what this says is we'll look back at a particular spread during a particular period in the calendar, and generally speaking, if you bought a spread on day 1 and then you sold it 30 days later, if you made money on the trade and it was profitable, then it is a winner. And we look for trades, I look for trades that have at least an 80% chance of 80% win rate over the last typically 15 years. Sometimes I'll narrow it down to the last 10. Sometimes I'll widen it out to the last 20. But on average, something that has a decent win percentage for the last 15 years. Then I'll go into the correlations. Now, what I want to do is kind of pull in some things here. One is just generally speaking, why do I think that spreads are a good idea? Well, there's a number of reasons. I won't go into all of them, but it is clear that certain times of the year there is a tendency for certain commodity markets to move in a certain direction. So let me pull in a couple quick things here for you. Here we go. This is let me get rid of some of the noise here. This is a unleaded gas futures graphic of how that commodity has done over the past 12 years in particular months. So in the month of February, for example, you see a typical 8.5% return for unleaded gas. You see in March, usually it's up 9.6%, etc., etc. And then you start to see it typically in July, August, September time frame over the last 12 years. That commodity tends to decrease in price. All right, compare that with the heating oil. Here's heating oil. Okay, so typically in the month of January, February, March, you see almost 2 to 2.5% gains in heating oil on average over the last 20 years. And then in September, October, November-ish, typically you see a decrease, or actually October, November, you see a decrease in prices as in May. All right. So basically what this is telling us is that during the calendar year, in particular months, these two commodities have a tendency to move in a certain direction. That's fine if you're an outright futures trader. You can go ahead and try to time that trade, but for various reasons, I prefer the spread market. So let's say in March, unleaded gas is typically up 9.6% over the last 12 years, and heating oil is up around 2.4%. A trade just on face value, okay, I wouldn't say I would do it, but a trade on face value would be to buy the unleaded gas futures and sell the heating oil. I mean, both are going up, but nonetheless, what if it's one of those years where it doesn't work out, right? So the futures spreads market kind of give you a little bit less volatility, in my humble opinion, than being in the outright futures. And those are when both markets are moving in the same direction. So that's just a quick snapshot of, looking at a particular calendar month and how a couple commodities can kind of work with each other there. All right, so if we go back to the PowerPoint here, so I'm looking at a win percentage of 10 to 20 year look back, and there's a trade that comes to my attention, and it is from a service provider who publishes this type of information on seasonal analysis for the futures markets. And it comes in, and here is a sample of what it looks like. So here, the source is More Research, and this is one of their free trades that they publish. All right, so we're just going to use that as an example. It shows that between August 1st and August 26th, 80% of the time, this trade has been profitable, where you buy December live cattle and you sell October feeder cattle. We won't get into what those contracts actually are, but let's just take it for face value, okay? So 12 out of the last 15 years, if you sold it on the 26th and you bought it on the 1st of August, you made money, all right? So we take this, and I'll take this as a starting point, and then we'll dig into it. And that's where the correlation information starts. I'm just going to show you this real quick, the seasonal pattern chart, so you can get a visual. Okay, so here's the trade, a visual of the graph of the trade. Okay, so the blue line is the pattern for the 15-year look back of this spread, buy and DC live cattle sale in October. And you can clearly see the green line and the red line are the start dates and the end dates. The black solid line is this year, okay? And it pretty much followed the pattern for the last 15 years, okay? So this one's already happened, but I just want to use it as an example, okay? So that is what the trade looks like, all right? That's what this historical tendency looks like. All right, so this is something that we start with as the foundation. Okay, so 12 out of 15 years has been profitable. This is generally what it looks like. You can see that both these markets were kind of moving into the lows back in the July period and steadied out and then pushed on up for the historical tendency. Okay, so that's the foundation. So then we dig into some of the details, all right, to be able to tweak the trade. So let me move this out of the way. This is what because when we move on here, let me just go back real quick. So we start with the win percentages like I have there, and then we go into analyzing losing years, analyzing large negative equity years, analyzing analogous years, or years that the price pattern looks real similar to today, and then we look at the spread price levels. So let's take those one by one. So when you actually look at the data for each and every month. Okay. Here we go. This is the data. So the year of the trade is on the left. Average entry date here. Average exit date here. Okay. And then it has other data such as when the best equity date was, when the worst equity date was, and then the quantities, best equity here and worst equity there. So basically, best equity is largest profit, okay? And then the worst equity is the worst loss. This cannot be right, minus 29,302. So I'll double check that. The data here is where we really start digging into and calling out some trades I don't necessarily think look that great. All right, so let's go look back here really quick. First of all, when I look at the statistical analysis, analyze losing years. That's number one. So in red, okay, here and here, we have the losing years. There was one more down here, losing year, okay? Let me widen this out. So 3 losing years out of 12. All right, so my big question right now is, does this year's spread look like any of those losing years in terms of the chart? Okay, so the very first thing I'll do is, does things this year look like any of those years in the past? And if so, that would be a mark against doing the trade. All right, I'm trying to filter out things that just don't look like they should work, in my opinion. I also not only look at whether the unresult was a loss, I also look at the worst equity, because this trade here in 2016 was minus $1,525 at one point. That's a big unrealized loss. It ended up making money, but at one point it was down $1,500, and most people aren't going to risk $1,500 on a cattle spread. All right. Ditto for this minus 590, ditto for this minus 632 and this minus 640. I mean, those are getting upward towards the higher end of a unrealized loss that most would want to withstand for this particular trade. So I'm going to look at those also. So I start with the years that had the worst loss, compare them to this year, and then see if that's a reason to filter out this trade. If not, I'll look at some of the worst equity to see if there's any reason to filter out the trade based on that. If that all goes clear, and just one quick note, this is the thing that those who are watching seasonal tendencies have to pay attention to. And one of those is, you might come across trades, and I've known some brokers in my life where they have basically said to a customer that, this trade's got a 100% track record. Well, a 100% track record sounds nice, but really the devil is in the details. And very few people are going to risk in this 2016 year here, very few people are going to risk $1,525 to make 362. All right. Very few people are going to risk even $640 to make 50. Okay. Very few people are going to be around when the trade loses, $1,200 like this. But that actually posted as a loser. But I'm saying within these trades that actually ended up winners, some of these, in reality, in my opinion, wouldn't really be winners because you would have been stopped out. So in this case, the 12 out of 15, if you subtract this $600 loser because somebody would have bailed on the trade earlier, it becomes an 11 out of 15 trade. All right. And this one here, risking 640 to make 50. Okay. That could have been the same scenario. So now you're talking a 10 out of 15 years trade. All right. So you really need to dig into the details. Yeah, making $50 profit on a trade in 2006, you get to call it a winner. There's no doubt about it. Making $27.50 in 2010, you get to call it a winner. No doubt about it. But, would you really have stuck around for that? That's the question. So that's something I look at and I keep in mind. All right, so I look at the worst equity amount, try to filter out trades that just don't look right there, okay? And then if we go back to the PowerPoint here, I also analyze analogous years. So I have the ability with software to say, does this year's chart look like any other years in the past where there's about an 80% correlation in the chart pattern? And the answer will come out yes or no. And if it does come out yes, the software will list which years have that 80% correlation. So I'll look at that too. And if this year's chart looks like other years in the past, I will see how similar they are and also have a idea of the backdrop of the fundamentals in the marketplace to see if I believe it could recur again. And that's for or against. Sometimes you look at correlations and it's like, this thing has a potential of becoming a loser and you might step aside. You look at a correlation and it looks like it could become a winner. Then, that just gives you an extra boost of confidence on one more aspect of the trade. All right. So I'm looking at reasons why I shouldn't do the trade. Okay. I'm trying to be devil's advocate in every one of the strategies that I publish. All right. And then I'll look at strategy or the spread price levels. So you can see in the past here that generally it shows the entry date and then it shows the entry prices. So you could see that generally speaking, the difference in the value of the contracts is anywhere from about 15 to 20-ish something thousand. Actually, probably closer to like 18,000 to 22,000. Okay, and that's fine. So basically, if you're in a year where, like in 2017, the entry price is at about 29,000, you're not that far away from where the market typically is on the terms of the price differential for these commodities. But when you start getting to minus 44,000, minus 47,000, or you get down to the 15,000 level, I mean, that's kind of, you're stretching the range, right? So you're at the high end or the low end of the range of where the difference in prices between December live cattle and October feeder cattle are. So that might be one where if I'm in the mix, you have a greater confidence. All right. If you're in an aberration, like something that's much higher, much lower than it normally is, quote unquote normally is, then that's something to just keep an eye on, and you'll want to look at how the spread acted when it was at those levels. So if, like today, we were at minus 50,000, I'll take a look at what the spread did when it was at minus 47,000 back in 2014 or minus 44,000 in 2015. Just to get an idea to see if this trade has viability this year. So that is the correlation side of the equation. Then we move on to quantifying risk and reward. So here's where we look at the worst equity and the best equity. And generally speaking, I will try to smooth that out. All right, so if we go here, now we go to quantify risk and reward. We're going to look at average worst equity and smooth it out, and we're going to do average best equity and smooth it out. Now, I call it smooth it out just because I want to get rid of the highs and the lows and kind of see where the meat of the matter is. So first thing, like I said, number one is if you're going to be a successful futures trader, you have to have two eyes on the risk and one eye on the gains, right? Because you need to protect yourself at all times. And here, in the worst equity, we had minus $1,200 in 2005. We had minus $1,500 in 2016. So at one point there was unrealized losses, over $1,000. 2012 it happened again. So I'm going to try and figure out where I think the sweet spot is in the worst equity so I can get a reasonable risk. So if you get rid of some of those higher numbers and you get rid of some of the lower numbers, such as these zeros in 2015, and the zero in 2012, basically it's saying that you bought at the low and it just kept moving from there, then we will try to find an average to come up with a reasonable level for a stop. So if you just kind of select the meat of the matter, it comes down to about 282.5 as an average worst equity. Okay, getting rid of some of the real high numbers, getting rid of the low numbers, roughly about $300. Okay, $300 or so seems to me to be reasonable risk on this trade. And then I work my way over to the best equity. So this doesn't necessarily mean, what this does mean is that at some point this was an unrealized gain. Okay, disregard this 2017 best equity. I think that's definitely wrong. There's some bad number in there. But generally speaking, the best equity for the trade here, if we get rid of the highs and get rid of the lows again, and you start going to the meat of the matter, I mean, this trade has made 5,000, 24, 2,800, 1,400, 2,300. So you see what I'm saying? I mean, roughly, it seems to me that, it looks like about I'd say $1,500 right in that level. Seems to be a good average best equity. So that would be the profit target. Okay, it's nothing set in stone. These are all written with highlighters, not fine point pens, but just something to guide us in terms of creating the strategy development. All right, and then once I have those numbers worked out in my head, the worst, which will be our stop, the best, which would be a reasonable target, then we move on to the technical analysis. So I'll look at this year's spread chart and put up my favored parameters in terms of technical analysis. Try to identify if it's a trending market, non-trending market. Look at some of the publicly available indicators, some lagging, some are envelopes, and trying to gain a feel for the marketplace relative to technical analysis to see if they can give me a clue on what I think could happen with the trade relative to the chart itself. All right, and then we basically just move into strategy development. And one thing I look at is, did the best happen before the worst, or did the worst happen before the best? What I mean by that is best equity date versus worst equity date. So what you'll see in the orange, okay, what you see in orange is that you lost money. You had an unrealized loss before you had your unrealized gain. So the worst equity happened before the best equity. Basically got in the trade, you lost money, then it came around and moved higher. All right. The ones that are still in white was the opposite. The best happened before the worst. All right. So the market popped in your favor and then fell back. It still could have made money. So for example, in 2007, the market had a best equity of $830. All right. And then it ended up losing $472 about 10 days later. But when they got out of the trade on the 24th, it had come back to make $130. So it was kind of a wild ride, an up, down, up type of situation. All right. But nonetheless, it tells you right there that the best was before the worst. If there's a pattern there, if there's like a strong pattern, this is roughly 50-50 on this trade. But if there's a strong pattern, then that will kind of help guide me on how to trade it. All right. So, for example, if the bulk of the trades have their best, okay, before the worst equity, that means the market tends to let you get in and then boom, moves your way pretty fast. All right. So that would be one where maybe we leg in to the trade, whatever multiples. Okay. You leg in, you buy one on day one, and then you manage that one. And if it does happen to pull against you, you buy another one. The other one would be if the worst happens before the best. And if the worst happens before the best, that'd be one where we are tweaking our entry point to buy on a dip first. Okay, we're looking for weakness off the chute rather than strength. We're looking for weakness. And that is how I look at it. All right, so I kind of compare which happened first, best equity or worst equity, to help me set the strategy for a particular trade. All right, so as we work our way down the thought process, we have the final is that you basically apply this analysis to the benchmark. So as we all know, there's a start date, average start date, and an average end date for all these seasonal tendencies. And I benchmark the closing price for a spread on the date of the average entry as I publish. So from there, what I do is apply the number I came up with in terms of the average worst. Okay, this is in the situation where I'm going to be buying a dip. Basically, in all these trades, not all these trades, but basically if you're looking at the 15 years worth of data here, at some point the trade was losing money. I mean, there's 2 years where it lost zero, okay, but for the most part it was losing money. And in my estimation, it was losing about $300. So rather than buy it on day one and fully anticipate at least a $300 unrealized loss, I'm going to wait for the market to pull back to that average loss level. So I'm going to wait for it to lose the $300 compared to day one and then buy it. And that's what I put into the strategies. This is how that helps. So now if you bought the spread on day one, just per the average entry date there, you would expect, based on analysis that I had here and the best equity, to make about $1,500 from that point, right? But if you wait for the market to pull back $300 before getting in, you can still keep the same best equity because that number hasn't changed. So normally in this trade, you get in, you risk $300 to make $1,500, okay? But if you wait for the market to pull back that $300 from the entry date, then you're risking $300 because we'll take that same worst equity amount as a stop level to make $1,800. The original $1,500 for best equity plus the $300 that you waited for the market to pull back. So that helps to push the reward to risk your way. All right, and that's all I do. That's basically it. And how that ends up looking is in our portal, and we take the trade there. Let me bring it up for you. Okay, and apply those numbers. So in the example of the, well, let me bring the this actual trade up. This is the Dees live cattle versus the October live cattle, or the Dees live cattle versus the October feeder cattle that we're talking about. Entry dates August 1, get out around August 26th. Benchmark was minus 30,502. Last trade is 30,045. So here's what the chart looks like, and this is how I publish it. All right. Now, with my strategy, we'd never have gotten into this profitable trade. So be it. That's just part of life. Trades are like buses. You miss one, there's another one right behind it. But I benchmarked the average entry date of August 1st, okay, and it was minus 30,502. I applied the average, in my opinion, the average unrealized loss, smoothing it out, which would have been minus 30,802, okay. Kept the same amount of risk, $300 or so, to 31,112, okay, and the same reward, roughly about $1,500 from the entry price, okay, and that's it. That's how we get to what you guys see. I mean, it's basically this long 12, 13 step process to kind of weed out, find some trades that has some kind of statistical tendency to it, number one, within reasonable parameters, and then try to call out or get rid of the trades that just don't seem like they make sense when you start looking at analyzing losing years and negative years, and you look at the analogous years and the spread price levels. So try to find reasons to not do a trade, and if they pass that muster, we start quantifying the risk and the reward, which is the average worst equity, the average best equity, back it up with some technical analysis, and then create the strategy development that you guys see. Hopefully this has helped you learn how I do what I do in terms of these trades. If you have any questions, feel free to contact me via email, or you can pick up the phone and give me a ring. I'm available. If I can't get to the phone, I'll be glad to. Please leave a voicemail, and I'll be glad to get to you as soon as I can. We will leave it there. Thank you very much.